Welcome, everybody. We'll give you a few seconds here to roll in. So we always have a big group. This is I always like to say, Murph, this is like not the most sexy topic that we get to talk about, but it's a really this is a really important, like you're almost to the end here, right? So it's a really important last piece before you're actually, well, we're middle of August, so some of you might already be driving your kids, right, to school. We'll see. But before we get started, why doesn't everybody just take a minute while everybody's rolling in here and put in the chat? I think we should almost have mostly class of 2025. Your kids are going off to college. So first of all, congratulations on that. That's a huge deal. I have twins and
Huge.
I get it. It's a big deal. But take a minute, just put in where your child's going to school. Put that in the chat. That'll be super fun to see. And then we'll do some quick intros because I know maybe some of you know us, but maybe not all of you. So take a minute, pop that in there. There we go. Endicott.
Endicott.
We got cap people like a stone's
Yep.
throw away from you. NYU. Oh, twins. Yay, just like me. I feel your pain. I feel your pain when it comes to paying. Oh, look at this. We got UT, Arlington. Awesome. You guys are all we're representing a big, Savannah College of Art Design. Very nice. Well, again, congratulations. So let's just do some quick intros. This one, we have a lot to cover, all about loans and how to pay, not just specifically loans, but also kind of teeing up the whole how to pay piece. Oh, there's somebody going to Bellingham. Love it. I used to live up there, not in Bellingham, but Seattle. So if you are not familiar with us, we're College Aid Pro. This is what we do. We guide families, we support families. The first slide is our mission, empowering families to shop smarter for college. Educating you on all the pieces of the journey is a key part of it. And as I said before everybody rolled in, I said to my co-presenter here, Murph, that it's not the sexiest part, but it is an integral part of this journey. So kudos to you for being here. If you haven't lined up all of your loans yet, some schools are quarters. I know Western is. So your child isn't starting for a while. And maybe some of you are still just trying to figure things out. So we're happy to show up and help you with this. I'm Peg Keough. As I said, probably my best credential here is that I have twins and I've been through this. So I get it from a parent perspective and have been doing this work with families longer than I want to admit. Long time. I started in the financial industry and then over a decade ago decided to just solely focus on this piece. And I'm happy to be here with one of my colleagues. You've heard me call him Murph a couple times, but Kevin Murphy. So why don't you just say hi and then we'll kick this off.
Yeah. Hey, everyone. I am one of the college planning experts here at CAP, and I too actually came from the financial services world, a different part of the financial services world, but that's how I got started in this. But why don't we kick it off? And you were
Yeah.
saying
So
it is an important part of the process. I would argue this is one of the most important parts of the process because if you do this right, you could save a lot of money.
yeah, yeah. And you want to look at this over 4 years. So a couple housekeeping items. We always get this question, is this recorded? Yes, it's recorded and you will get the recording. So if you get distracted, you want to share with anybody else in your household or friends or whatever, you'll be able to do that. And then we are both here. We're going to do our best to answer as many questions as we can. Please put your questions in the Q&A versus the chat. Like I asked you to put in the schools in the chat. If we want you to put something in the chat, we'll tell you. Otherwise, focus on the Q&A. We're going to look in one place. You can be anonymous, so it's just easy, right? And some questions people want to be anonymous. So let's kick this puppy off. Okay, I already did this one. This is who we are. Very mission driven, and these kind of educational events are a big part of what we do. So we're super excited. We love our NSHSS audience. So super excited to be here with you guys. So before we go deep into loans, I'm going to very quickly, because I'm sure it's on all of your minds, I want to talk about the one big beautiful bill, because there are some things that won't affect the 25-26 school year that your kids are about to start, but they will kick in after that. So, and some of the 529 stuff actually kicks in now. Um, so, as this slide says, the majority of it is for your child's sophomore year in college. But you really, as I kind of dropped subtly, but I shouldn't have because it's a main point, and I know Murph agrees with me, this is a 4 year, hopefully only 4 years, and it's a 4 year deal, right? So you want to think about this from a loan perspective, from how you're funding this over all 4 years. That is vitally important. I'm here to tell you, as a parent, it will alleviate a lot of stress. So that's why we're talking about this, because it might not be applicable this year, but there is a key thing that you need to know about for subsequent years. So let's talk very quickly. If you are Pell Grant eligible, lot of good things here. The Pell Grant is remaining the same. There was talk about reducing it significantly. That didn't happen. They funded Pell. The definition, say you have older kids, the definition to be a full-time student to receive Pell has stayed the same. It's 12 per semester. Pell can only be used to pay direct costs. That's a new thing. They created this workforce Pell Grant program. So the Pell Grant from the federal government can be used to pay for additional things. So that's all good. And if you happen to have foreign income, that's going to be part of the Pell calculation. So if that's you, just, jot those things down. So a couple provisions on the loan front. Subsidized loans, which Murph's going to talk about in a few minutes, they survive. So I'm not going to get into that. He's going to go into depth of what that is. Good news is it's still around. There is a loan that Murph's going to talk about called a Parent Plus loan. It is capped. Again, I'm going to and Murph really hit on this with the 4 year ramifications. He's going to touch on that in a few minutes, so I don't take a lot of time on that. The Grad Plus loan, which is for grad school, is eliminated. Only reason why I have this in our deck is you might have a kid who's wanted to be a doctor since he was 6 or she was 6, and that hasn't changed. Keep that in mind, because the loans available for that are not the same as they used to be. And then for graduate school, again, if you have a law school, med school child, it's going to be capped at 50,000 in these direct grad loans. Just planting that seed that that's something you're going to want to dig in further, because you have more than a 4 year plan. Quick few other things. The small business exclusion that used to be used to be all, for the last 2 years, all businesses were included. Their value, now it's going to be back to the old school for next year. So if you're a business owner, maybe you didn't get a lot of need-based aid because your business had significant value. And I would also say maybe you think your business does, and actually it doesn't. So I'm planting that seed because that's a common error that parents make. But the good news here is, if you have a family-owned business with less than 100 full-time employees, that value, starting with the FAFSA that goes live to the masses on October 1, is now going to be excluded. So that could be an opportunity where maybe you're going to get more need-based aid, or you're going to get need-based aid and you didn't. The loan repayment options are going to change starting July of next year. There's going to be a standard, and then there's going to be a repayment assistance plan. So all these other pieces that you've heard about, those are not going to be offered starting next year. So just keep that in mind. Couple things on the college front, not going to get in the weeds on it. The college endowment tax did increase, and schools with less than 3,000 kids, it's not applicable to this increase. Only reason why you should care about that as a family with a child about to go to college is it's a strain on cash flow for them, right? For the colleges. So that could affect aid. It's not going to be immediate, right? None of this is immediate, but it could. College accountability, this is a good thing. I want to see how this plays out. At CAP, we're really looking at this. The colleges are going to have some ownership. They can't be graduating kids that aren't even making so many years out what a high school graduate makes. So it's giving them some accountability with the loans that they just dole out. And then 529s, good things with 529s, more things that are qualified distributions. And I'll touch on that in a few minutes. So let's get into the loan piece. This is kind of the how to pay part, and then we're going to get into the how to borrow. So timelines here. It's mid-August. You can see up here in our top little quadrant that you all might have kids that there's already bills due, and maybe you've already started to pay a bill. So, and you're trying to learn now, how can we take out loans for maybe second semester? So it's game time for everybody, even if your child's going to go to a school that's quarters. I'm going to talk about payment plans in a few minutes. Those typically start even earlier based on when the semester or the quarter starts. You'll get used to the cadence. I remember with my kids, my son was at Indiana University, go Hoosiers. I didn't see that anybody was going there, but his bill was actually due right at the beginning of August when he was starting toward the end of August. My daughter, who is at JMU, go Dukes, hers was due the first Friday when classes started, which was in September. So a month apart. So you're going to get used to the cadence with your child, or the family with twins. Your kids could be really different of when the bills are due. So you'll get used to that. That's not really rocket science. It's just new when you're getting into this. We say up here, cash flow is king. The point here is this is a great time. I'm a financial planner by background, so the term budget is near and dear to my heart. It's my comfort zone. I'm sure my husband doesn't love that because everything goes back to the budget. But a lot of people, when they hear the word budget, they kind of cringe. I would really challenge you here that budgeting is super important. Murph works with hundreds and hundreds of families. He brings this up in the first meeting when he's talking to the parents. Like, it's vitally important. If it's not your comfort zone, that's okay, but it's a growth opportunity, right? You got to embrace this. And as this slide shows, if you can find an extra $100, and sometimes it's easy to find because you're spending money on your child that you don't even think about, like, oh, that's going to be over. Like my son, I literally saved almost 100 a month in my Costco bill because he ate so much, right? There's different pieces here. If you can find those funds, any way you can borrow less, obviously, is for the better. And so we say kind of hit that reset button. It's an opportunity for you, your financial junk drawer. They always say people have all these subscriptions to streaming services or the gym or whatever, just to really think about how you're spending money. And without a budget, it's kind of hard to do that. So I would really recommend, it'll benefit you for your retirement planning as well. So it's a win-win to do that. Okay, so let's talk about these payment plans. Almost, excuse me, every school in the country has these. Usually they're going to be front and center, and they're going to publicize them. They want to make it easy for you to pay them. Typically there's an enrollment fee. You can always ask for them to waive it, especially if your financial circumstances, it's expensive for you. The worst they can say is no. But there's a one-time fee typically, and then they divide it. However they do it as a school, they're going to have different deadlines for the payments. They'll all be slightly different, but that might help you from a cash flow standpoint. If you're going to fund a bunch of this that's not loans through cash flow, you probably don't have the full amount, right, on day one. So if you do the payment plan, that can really help. So if that's new information to you, reach out to the school and see what their payment plan offerings are. You want to reach out to the financial aid office and see how that works. So let's talk again. We're talking how to pay here. So let's talk about some resources that you might have. And I should really rework this slide and put college savings plans at the top bullet, because that's the one, if you've been fortunate enough to be able to save, and if you haven't, no worries, right? You're doing your best. But if you have a 529 or a prepaid tuition plan or what's called a Coverdell, this is all money that you saved and earmarked for college. Okay. People always ask, Murph and I, we meet with people like, shouldn't I just use up my whole 529? And then, when that's out, then I'll figure it out. Not necessarily, because Murph's going to cover, and he'll touch on this, why that's not always a good idea. Every family's different how you should use these accounts. Of course, you saved it for college. They need to be qualified education expenses. You can use it for that, but not necessarily use it all up and then go, okay, what do I do next? Right. If you have other college savings, very common that grandparents have earmarked money. It might even be in a 529, it might not. That's all part of that 4-year plan that I'm talking about to lay out. And even though your child's about to go to school, it's not too late to do it. Do it for your peace of mind as well. And then the top bullet, if UGMA slash UTMA means something to you, that means you have this type of account. It used to be the only game in town to save money for a minor. And so that's actually an asset of your child. It needs to be used for the benefit of them. Doesn't need to be college, unlike 529s where it needs to be used for qualified education expenses. If you have those accounts, we're going to talk at the end how we can support you. Might be worth talking to us because there's some strategizing there. You want to maximize what you get from the colleges. Little bit of depth on the 529s here. I mentioned this already a couple times, this term qualified higher education expenses. There's restrictions on a 529. You can pull it out for certain things. Pretty much you can pull it out for the stuff you would think: tuition and fees, room and board, books, anything that the college requires. If they require you to purchase a certain laptop that they upload with some of their stuff, great, but not travel. That's the main one that most people logically think they can. But per the IRS regulations, current regulations, you cannot buy plane tickets with that money. And what happens is if you don't use it for qualified higher education expenses, you're going to pay tax on the earnings because this grows tax free. That's the beauty of a 529. And you never pay tax on the earnings as long as you use it appropriately. And you also pay a penalty, a 10% penalty. So you want to be careful with that. How do you get the money out of a 529? You can either have it sent directly to the college, or you, if you're the owner, you can have it sent to you, deposit the funds, pay the bill, keep a paper trail, throw it in your tax file. It'll probably be 5 years if you have a 529 that big, because it's tax year, it's not school year. The IRS could care less about a school year. So you've got this tax year where your child's freshman year, and then next year's freshman sophomore year when they graduate, that's yet another tax year at the end. Okay, keep a paper trail of proof that you're spending it on qualified higher education expenses. And then last but not least, the IRS does not like you to pull money out of a 529 in a tax year and then spend it in a different tax year. So example is most common, you pull it out end of December to pay a bill that's due January 5th at your child's school. Don't do that. Pull it out in December and pay it in December. Just pay it early, or pull it out in January and pay it in January. You're going to get into issues with the IRS, and nobody needs to get letters with the IRS in the return address there, right? That's where all of our adrenaline runs, right? So that's just a little tidbit on that. So just some tidbits here. And then lastly, on this how to pay, there is a wonderful tax credit called the American Opportunity Tax Credit, AOTC. It's $2,500 per child. So the mom that put in, she has twins, if you're eligible, and you can see the eligibility here, your adjusted gross income has to be under 160,000 to get the full credit. It's per child. You have triplets, that's 7,500. And what a tax credit is what it means is you owe, say, 20,000 in tax on page 2 of your 1040. If you've got a $5,000 credit, you now owe the government 15,000. It comes right off of your liability. It's money in your pocket because you're saving, but it's not money in your pocket like being sent to you. And so some people, it's good to know about this. Some people, they're not going to say, oh, well, I saved that money, so I'm going to pull it from another bucket to pay for college, but you could, right? Key thing here is if you want to be eligible for this credit, you have to have the income requirements, but you have to spend 4,000 on tuition and fees and books, not room and board, out of an account that doesn't have a tax advantage to it. 529s, as I've discussed, do. So this is very common. People pay the bill with their 529 and say, Well, I make 150. I'm going to put in for this tax credit. And if you have a CPA doing your return, he's going to say, you can't do it. So I'm telling you this now. So if you are eligible for this tax year in 2025, when you're doing your return in 26, you don't want to learn it then. You want to be able to take advantage of this tax credit each year. You do have to be claiming your child. So if you're divorced, I know a lot of people flip on who claims. That doesn't really matter in financial aid. We're talking tax here. So it does matter for AOTC. You can't claim AOTC on a child that your ex has as a dependent on their return. So keep that in mind. Okay. Now let's get into the how to borrow section here. So general borrowing rules here. Just like almost everything in this process, things are unique to your family. Like it says here, no one size fits all. And you're going to get it. We're about to go through all these different types of loans, and certain things are going to matter to you. You're going to have certain criteria, and that's what's going to dictate what's best for you. The other thing that's key is you have to know how much is too much to borrow for your. We have some cap rules that I kind of agree with, and when we talk about them, I'll share how little caveat on one of them. But you have to have your comfort level. And all the families I've worked with through all the years, I'm like, the last thing I want for you is to be laying in bed, staring up at the ceiling, not sleeping, because you're over your head and your child's only a sophomore. We got to remember, whatever you do, if that's a strategy for all 4 years, you've got to think about it that way. So let's dive in here to this is just to show you our affordability profile. And when you're in our software, which I know a lot of you are, actually, you can put that link in the chat if you want, Murph. If you're brand new to us, you're probably not in the software. It's hugely beneficial. There is some help at this point in the process, but if you have younger kids, hugely helpful. But this is kind of our cap, like our affordability program profile. Obviously, no loans is ideal. We all would love to have that. If you only have loans of the federal direct student loan program, which Murph is going to talk about in about a minute, that's great. That maxes out for most students at 27,000. We're calling it good if your loans are below your expected first year salary. That's where I have the little caveat, because many kids go to school thinking they're going to major in this and be this, and they change their mind, right? That's so common. What I studied in college is not remotely similar to what I'm doing now. I didn't change, well, I did change my major, but my second major isn't even close to it. So that's where you got to be a little careful with that one. And then, of course, if you are way over what you might make, that's where we're going to tell you caution. And here's some examples of just like average 1 year salaries. This is going to depend on where you live, what school you went to. All that information is actually in our software. You can go to Boston University and you can see what a business major makes on average in the first year. And so you can actually see that. So those are kind of our, high level, trying to keep it front and center, because it can get very emotional in this process where your child loves a school, you want to make it happen, and you end up getting buried in debt to make it happen, which isn't good for your child. It isn't good for you as parents. It's just not a win-win at all. So that's what we're trying to help you understand here. Okay. All right, I'm going to let you take over here, Mark.
No, that's awesome. I left 3 questions in the Q&A for you. But so in terms of types of loans, well, it's important to understand the full breakdown. The federal direct student loan is what you're probably familiar with and what you've seen on the College Financial Aid Award. There's also the Direct Plus federal loan, private student loans from private lenders, state loan programs, which we'll dive into in a minute, and then a loan from the actual college or university themselves. So there, as you can see, are many different types of loans. And what's going to be important is essentially doing your homework and spending time comparing all of these options to figure out what works best for you. Now, alternatively, you could use things like home equity. You could use a 401k, which we'll dive more into, but maybe a loan from a family member. And then also, if you have a cash value life insurance policy, oftentimes you can borrow from that as well. So there are some other options that aren't traditional student loans. Now, in terms of federal direct student loans, the loan that every student who files the FAFSA gets is going to be broken down into two tiers, but also the loan amount is going to be based on, we have it as school year, and it's the easiest way to think of it, but it actually is based on credit hours, right? But freshman year, students typically have less than 30 credits. And tier one of the loan, which could be subsidized or unsubsidized, would be $3,500. Tier two, which is always unsubsidized, unsubsidized accrues interest as it's dispersed, is 2,000 for a total of 5,500. Now, sophomore year, which is 30 to 60 credits, tier one goes up 1,000. And tier one, again, could be subsidized or unsubsidized. So you might get, depending on your student aid index, you might get an interest subsidy from the government, or you might not. And then junior year, which would be 60 or more credits, same with senior year, would go up to $5,500. And that would be a total loan amount for those 2 years of $7,500 each year. Now, over the 4 years, $27,000. I just want to note two things. One, this could help in terms of the American Opportunity Tax Credit. And then two, in terms of 529s, you can only use $10,000 over a student's lifetime to repay a student loan. So if that's part of your strategy, even if you were to borrow this full loan amount, there'd still be $17,000 left over if you leveraged a 529 and paid everything you could back. Now, interest rates for these loans are based on the 10-year Treasury yield set in May. This school year, 6.39. Next year's loan, totally different. You won't find out typically until June. So that's something that you have to keep up with and you have to stay on top of, but the interest rates do change year to year on the individual loan.
Yeah, they're fixed rates, which is nice. And as we said
Yeah.
on the slide here, it's use it or lose it. That's why that 4 year, like when I was talking about 529, you say, well, I'm just going to use up my whole 529. I don't need it freshman year.
Yep.
Well, if you say no to this 5,500, that could be the best loan out there. First of all, if it's subsidized, it's a no-brainer, right? You're not paying interest on it until 6 months after graduation. But even if it's all unsubsidized because you don't have need, you want to think about that before you say no, because you can't go back and get it in subsequent years. So that's why that 4 year plan is so important.
Absolutely. And to that point, even if you don't necessarily need it, there are many benefits and reasons to take it out. It helps your student establish credit history, which could be even important for borrowing in subsequent years because some lenders do use student FICO score. Also, nothing says you have to keep the loan, right? So you can have your student take it out, immediately pay it off or pay it off very quickly, but you don't have to keep it for the entire term. There is an origination fee. It's 1.057%. So you would be responsible for that anytime you borrowed it. And one of the things, and this year proved it, previous years always, on appeals, they look at this, right? They want to see that the student's doing what they can. And sometimes the appeal is even contingent on the student taking the federal direct student loan. Now, for a student to take this, it's really simple. They have to go and accept it in the financial aid portal with the college. And then aside from that, loan entrance counseling probably takes 20 to 30 minutes, and that's right on studentaid.gov. And then there's also the master promissory note, which explains to them their rights and responsibilities as a borrower, very quick, all done probably in 30 to 40 minutes, and they have this loan. And again, all through studentaid.gov. Now, Parent Plus loans, and these, we've already had a few questions in the chat about the Parent Plus loans and about changes. So these are the biggest changes as part of the Big Beautiful Bill were to the Plus loan program. So starting next year, as Peg mentioned, there will be caps, right? Any loan originated July 1st after next year, first time borrowing, right? If you didn't borrow this year, would be $20,000 in a year. or $65,000 for a student's lifetime. However, right, if you were to take any loan amount this year, you would technically be grandfathered in to no limit. And that's important to consider if you're going to be borrowing, maybe as part of your overall plan and your strategy, even if you don't necessarily need to take the Parent Plus loan. If there will be loans in the future, it's worth considering. Now, to dive into a little bit further, it is a federal loan. This year's interest rate's 8.94%. One of the biggest expenses associated with the Plus loan is the 4.228% loan origination fee. So that's super important to consider, even if you're going to be taking this out, even for just the purpose of insurance in the future and being able to borrow, you will still be responsible for the origination fee. And it's the easiest loan to qualify for, right? They don't look at your debt to income ratio. They don't look at really too much more besides just basic credit check. And because of that, this is not only the easiest loan, but historically speaking, it's been the fallback, right? It's been the, if I don't qualify for a good private loan or a state loan, this is what I might end up taking. So there are definitely some benefits to taking the Plus loan or even considering adding it to your plan this year if you normally wouldn't have taken it. Now, the Parent Plus loan, any parent on this call, it's totally in your name, right? It's not in the student's name, but nothing stops your student from helping pay it back. It's just they don't have a responsibility. It's not in their credit report. It's not in their name. You find out instantly, right? Instant credit approval if you've been approved or denied. And these caps moving forward are going to be really, so if you have younger students, right, this is going to be a really big consideration. $20,000 a year for a student, but $65,000 for their lifetime. Depending on, how much the college costs and how much you need to borrow, this might not be enough to fund it. So you need to start thinking about loans now, big picture. But it's also something where, as I mentioned before, you can get grandfathered in for your student who's about to start college this fall to no limits. And definitely, if you have questions on this and you're unsure of what to do, I think we'll be sharing some info, but you can absolutely meet with Peg, myself, or anyone on our team to dive into it.
Yeah, because I was just answering, Maureen put in a question. So, Maureen, I'll just answer it live here. Yes. That's the big push here is if you take out loans for this 25-26 school year, as the slide says, you're grandfathered into the current caps are the cost of the college, which Murph and I are not recommending that you take out the cost of the college if you
Yeah.
get no aid at all, minus, potentially unsubsidized direct federal student loans. We're not pushing for that. We're just saying our group of families that we do our comprehensive package with, we wrote to all of them and said, please talk with us. There could be a real reason to even take out just $1,000 of these loans this year. We're not making that recommendation to the whole audience. We can't do that. We have to speak with you individually, but we want you to understand that will grandfather you into the current caps, which are basically the cost of attendance. Otherwise, if you don't take it this year, then you're under the 20,000 per year and 65 overall for the undergraduate years of school. So, all right. Sorry, Murph. Just chiming in
No,
there.
it's nothing to be sorry about. So state loan programs, these programs are great. Now, sometimes the state you live in may offer a loan program. For example, I live in New Jersey, and here we have the New Jersey Class Loan Program. But sometimes you might live in a state like Florida, for example, that doesn't have an in-state loan program. But, right, if your student were to go to college in New Jersey, you could take advantage at certain schools of our New Jersey Class Loan Program. Also, there are some states like Rhode Island, Massachusetts, Iowa, Kentucky. I know there's probably one or two I might even be forgetting that lend to everyone, regardless of where you live in the country. They will let you borrow. So there are some different options, whether you live in the state that offers it or whether your student's going into the state. But always check if they're going to go to a certain school, check that state if they have a student loan program like Indiana. We were talking about that before. they have a state loan program. So check with that state, see if there's a loan program. And typically, when it comes to a state loan program, they're going to be more similar to a private loan in the sense that the student's the borrower with the parent as the co-signer. But I do know some of the state loan programs have a parent-only option as well at typically a slightly higher interest rate. And all of this, thankfully, is done online nowadays, right? So everything is electronic. And you do find out relatively soon, right? 24 to 48 hours, but it's not instant credit approval like the Parent Plus loan program. So there could be a delay in figuring out, hey, are we approved or are we not for one of these lenders? So good to keep in mind though. Now, private student loans. So private student loans, they're going to be very, very, very dependent on your credit score, on your debt to income ratio. And typically speaking, the student is the person who's responsible for these loans. They're the borrower, right? And the parent is just the co-signer for the, excuse me, I was going to say the endorser, but yes, just the co-signer. And it doesn't just have to be a parent, an aunt, an uncle, a grandparent with good credit income to support the loan could be the co-signer. There's so many private student loans. You have to do your homework, you have to shop, you have to check the lenders because there are a lot of different options. They have a very, very quick application process. It all online, very simple, very straightforward, probably 15, 30 minutes for some of these applications, very simple. And they do try and promote the variable interest rates. So you might see variable, but always keep in mind fixed as well. And with private loans, there's typically no origination fee. So no upfront fee like the Parent Plus loan or the Federal Direct Student Loan.
Okay, so I'll take over here, give you a breather here, Murph. So remember when he went through that slide that was kind of our table of contents, if you will, of different ways to pay for college. So we'll touch on these because, they're part of the mix for some families. This one was big several years ago when interest rates, dropped, right? We all remember those days. And some of you might have some really, maybe you refinance and you've got a really nice interest rate on your mortgage. That's awesome. Um, these strategies are not as much in play right now because of the interest rate environment. Because I would strongly encourage you, don't make decisions just based on college. You want to look at your overall total picture. So if you're sitting on a really nice interest rate, say you even are lucky enough to have a 15-year mortgage, right? And you've got I just sold my house a few months ago and I had a 2625 15-year mortgage. I mean, it was a sweet deal, right? You wouldn't want to, I wouldn't have wanted to refinance that because I had a decent amount of equity and do what is called a cash out refi. I would take some money out and then have a new mortgage because the interest rate would be in the sixes, right? Or fives maybe for a 15-year. So that wouldn't make sense overall. But these are things that can happen. If interest rates drop, if the Fed starts lowering interest rates, we'll see. This could be a thing. So a cash out refi is when you're refinancing your house and you're going to be subject to the current rates. A home equity loan, that's where you're taking a loan. The downsides of that is the interest rates could be kind of high. And also you take a chunk of money out, it's sitting in your account. And then when you do financial aid forms, it's not retirement money, so you're going to have to disclose it so it can affect your need-based aid if applicable. The last one, the home equity line of credit, called a HELOC for short, that one's a little different because you can go to a bank and say, hey, will you give me a HELOC on my equity, the market value minus your loans? And if you're sitting on a lot of equity, they might say, well, yeah, we'll give you a line for 150,000. That's not a loan sitting in your account. That's just a bucket of money that you can draw from at whatever you pull. Say you say I need 10,000, you pull that money, you're going to start paying interest on that the day you pull it. But you're not disclosing all of that money on a financial aid form because it's just a line of credit that's sitting there for you to use. So for some people, even now, depending on their situation, I might say, well, check out your HELOC and see what you can get, especially if your credit score is lower. I mean, that's where all these different pieces come into play. But en masse, the home equity strategies we're not implementing as much right now just because of the interest rate environment that we've been in for the last few years. But that is always an option. I've had a few people through the years. I had one dad who was just like, I'm doing it, Peg. This is what I want to do. And so I just informed him of the scenario. First of all, you have to check and see if your plan even allows it. It's every plan is written by the employer. They pick the specs that they want. You are, as I said, I'm a financial planner by background. You are literally robbing your retirement because I'm sure when you started your 401k, it was not with the intention of using it for college. Usually it has to be repaid within 5 years. If God forbid you lose your job, it's due right away and interest is set by the plan. So it's something you can check out, but for CAP in general, this isn't a place that we tell people as a go-to. Um, if this is your last resort, depending on your situation, it might mean that the school is not affordable. And I know that's kind of hard to hear, but in sometimes that's the case. And then life insurance, as Murph said on the table of contents slide, um, cash value life insurance. You might already have a policy that you did with an insurance specialist, your financial advisor, it fits into your plan. You can look into that policy because not all policies are the same and look at taking a loan off of your cash value. This is a case by case basis. It's better from a financial aid standpoint to take a loan off it, not take a distribution. Because that can impact financial aid if you're getting need based aid in the year that you do it, it can impact it. So you want to keep that in mind. So we're just planting the seed. There are insurance people out there, there are companies that have been created to go to consumers like yourselves that have high school, college bound kids and say, you've got a chunk of money, put it in a life insurance policy. There's a lot of moving pieces there. So I'm just planting that seed too. If you have younger kids, you got it. But we do that with some of our clients, but it's not a high percentage. All we have to check all these boxes. And it just has to make sense for a given family, and it's not a one size fits all by any means. But just so you know, if you happen to have one of these, talk to your financial advisor, make sure that they understand financial aid. If they don't, you want to get help because a lot of CPAs, financial advisors, insurance people, they're not us. Like they don't understand what we know. So you want to make sure that you're getting good, comprehensive advice around that. And then to wrap up here, we had the general borrowing guidelines. So now that you understand more after everything Murph went through about the different loans, it isn't one size fits all. Like I said, it really, of course, everybody wants to get the lowest interest rate, but like, how much does that matter? What's your credit score? That Parent Plus loan, it's much easier to get a Parent Plus loan than it is to get some of the other loans that Murph talked about. It doesn't mean you should run and grab it. I think a lot of people use it as a last resort. It's always good to, Murph will ask people to pre-approve themselves to see what they might get it from different lenders. And we hear stories all the time that people that have great credit scores don't necessarily get a great interest rate at some of the lenders that are out there because maybe they're looking at your child's credit score as well. Like there's a lot of moving pieces here. So all of these questions on here are things that you should be thinking about when you decide what your loan strategy is. The last one here about equity, I think I covered that pretty well. That's not really a great place for most families, except for maybe having a HELOC as an option and seeing what that rate is. That rate is going to be variable. I've never seen a HELOC rate that's not. We're not right now, if you're a betting person, interest rates probably aren't going to tick up They might tick down. We've got a lot of uncertainty right now in that area, so we don't really know. If I had a crystal ball or Murph did, we could make our predictions and do our thing and retire, right? We'd be wealthy. So none of us
Okay.
really know, and it is an uncertain time. So all of these pieces come into play. So we couldn't say to all of you as an audience, hey, this is our recommended best strategy. We were trying to arm you with all the information to understand the pieces. And what I would say is, oh wait, I think I have one more slide. Let me just show you this, and then we'll talk about how we can help you. If you're sitting there going, all right, that's great, but I would love to talk to you guys to understand what my unique, now that I understand this, what I have a feeling that I know what's best for me, but really what is best. This is just to show you the difference between, if you look up here, 8.94, as Murph said, that's the plus loan for this coming school year at the fixed rate with it's an exorbitant origination fee, in my opinion. And then the private loan at 7%, as he said, there's no origination fee. So how does that play out over the life of that loan as far as how much of a loan you're taking? What's your interest savings? That's a massive, at least in my book, that's a massive amount of money to save. And then you're saving in the loan fees. Loan fees it's a fee, right? You're losing that money. So the point is, you might say, well, that's not that much difference in an interest rate. And look at the savings over the 20-year life of this loan. So it is really important, as Murph said way at the beginning, we were introducing ourselves, to dial this in. So with that in mind, let me just talk about how we can support you ongoing here. And I'm gonna put this link in the chat, and I'm gonna share my screen. We are more than happy to meet with you one-on-one to really discuss your unique way to cover this. I know some of you put in the chat, and I'm put in the Q&A, hey, I've already done this for first semester. Totally get it. Your kids, you might be ready to drive them to school soon. You had to do this, but you can still plan for next semester and the rest of the 3 years. So the link is in the chat for this. Um, we have a team of experts. Murph is one of our experts. I personally was charged with doing this when I first joined CAP. Go find some more people like you, Peg. And I think I've been pretty successful doing
Mhm.
it, finding people that have been around the block. They really know their stuff, and we know our stuff inside and out around these loans. We can look at your situation and really understand. So grab this link. We're going to send it in the follow-up, but you see here we have a coupon. We love our live audiences. So we'll give you $75 off. Full price is $299. So it's a really nice discount. You would put in the HTP 75 and it'll back it right out. Like you just put it, I was testing this earlier. That's why it says code invalid. You just pop it in, it'll take off that $75. You hit pay, then you'll be able to sign up for an appointment with our experts where we can dial in what is the right strategy for you. You saw the slide of how expensive this is, and difference in loan amounts is really important. So to me, if this is keeping you up at night, if you want to talk about, Peg, you keep mentioning this 4-year plan. What is that about? That's what I want. I don't need loans, but right now, but I want to talk about the 4-year plan, or I want to understand better. I have an UTMA or an UGMA or 529, whatever it is that's keeping you up at night, or whatever questions specific to you are rolling around in your head. That's a good thing that Murph and I have kind of got things moving around up there, right? And so we're more than happy to do this. You want to use this coupon by midnight tonight. We want to give you a sense of urgency. We don't want you to put it on the pile and deal with this later. This really is kind of game time, unless you have a younger child and you're just a go-getter, in which case get in our software and start working through stuff. But I think almost everybody on here has a student going to college. Anything else you want to add,
I
Murph?
would just say you mentioned it, but we've got an amazing team. What's most important this time of year, if you're going to be meeting with us, which anyone who's taking loans, quite frankly, I would suggest it, but meet with the first available person. we're at a point where you're probably 2, 3 weeks away at most from owing the college money. And it takes a week or two to secure a student loan. So, although Peg and I would love to meet with all of you, please just meet with the first available pro on our team and you'll be in excellent hands. But again, if anyone has questions about a 4-year plan, about student loans, think about the advice we could provide, not just for this year, but you're going to have to go through this every single year and you're going to be able to go back to that advice and essentially reuse it in future years to make sure that you're set up. But that's all I wanted to add just because it's August 19th.
Yeah, it's a good call. Time is not on your side right now.
Yeah.
Even if your child's going to go to a school with quarters, and you have some time, but as we talked about with the payment plans and everything, things can be due. We're trying to reduce your stress here. And
Yeah.
it's hard. It's a stressful journey, but as I always say, it doesn't have to be as stressful as it is for many families. And we're here to reduce the stress. So I hope you got some gems today that are helping you kind of put this into play. Please book a meeting. Use that. Yeah, as Murph said, it was a great call. You'll see once you pay, the first thing up there is next available. If you want to meet with Murph, go ahead and pull it down. But if he's not available tomorrow, which I'm guessing he's not available for quite a bit, and I know I'm not either, just go with next available. Or if you know another pro because you have been on other webinars, go check them out. But if they're not available, do the next available because you really want to jump all over this. So all right, Murph. Well, thanks for joining me today.
It was
And
fun.
again, congratulations to everybody. I know this is a journey, and your child, it's a little bit, it's melancholy because this is what you've been trying to do for 18 years, right? Get them to where they can at least take this, I say, half step to being adults, because you're probably paying some of the bills still. But it's hard. I mean, I always get like, I get a little choked up right now, not gonna full out cry, but I remember saying goodbye to my kids. I remember that day. It was different for both of them. And the person who has twins, I hope that it's not the same weekend for you. And I will tell you, my kids graduated on the same weekend, so I had to figure that one out. So I don't wish that on you, the mom in here that has twins. So, anyways, um, glad to have you today. Hope you learned a lot, and everybody have a great day. And we will see you next time.
All right, everyone. Bye.
Take care.